If you need money back in the next year, listen carefully because a lot of smart people are making a dumb mistake. They take 1 year money and they invest it like 10-year money, right? So that's a big mistake. We don't want to do that. We want to invest intelligently. The stock market could drop, the deal can get delayed that you wanted to do, crypto can crash if that's your thing, or their businesses, you may need cash in your business. Now you need your money at the worst possible time. And here's the rule: 1 year money should behave like 1 year money, right? Today, I'll show you exactly where I'd park cash for 1 year and where I would not. Looking at an example of, let's say you had $100,000, what would you do with it? So, welcome back to Prosper Without Permission. I'm Denny Troncoso. I'm a real estate investor and developer, and I spend a lot of time thinking about risk, returns, and protecting capital. I also invest in the stock market as well. So, let's get into it. Most people do one of two things. They make two mistakes, right? Number one, they earn nothing, right? So they just put their money in a checking account. The money's sitting there earning basically zero, right? Checking account's not doing much. It's called lazy money. That's what I would say, right? Or number two, they take too much risk, right? So they chase returns with money they need soon, right? They were like, man, I'm just going to put this money to work and I'm going to put it in a place that is going to generate a good return, but then it can create problems. So it could create forced selling, and forced selling destroys wealth. So, for example, if you needed a house down payment in 10 months, you put the money in stocks, the market drops 22%. Right now, what? You basically lost 22% of your money because you're forced to sell. You need the money now. You exit it and you lost 22%. So you're destroying wealth, right? So you either have to wait, delay your plans or sell at a loss, right? And that's a bad position. We don't want to be in that position. Timeline matters more than our optimism. We want to put ourselves in a good position to succeed, and we have the odds in our favor, right? The odds are in our favor. So, where are the best places to park cash? And we're talking about parking cash is going to be a year or less that we're putting money in. We don't need it, and we want to get it earning something in this interim timeline, right? So, option one is a high yield savings account, right? This is a boring place. And boring is good, right? For money. Sometimes you don't need a lot of activity, a lot of action. You just put it in a place that earns a good return and you're having sitting there. You don't have to worry about it. Boring is beautiful, right? When money has a short timeline. And you get liquidity. You get something called this FDIC protection within limits. This is protection from the government if the bank goes, disappear, go bankrupt. Interest, right? So you're getting your money, and then you have easy access to it. You same day, basically. I did do some research for you, and then right now we're talking about recording this in April 2026. Barclays has a great high yield savings account, but if you look online, you can Google it. A lot of different other options that you can find a good competitive high yield savings account to put your money. Now, option two, something to consider, and a lot of people don't talk about, is treasury bills. Treasury bills are basically you lending the government money. Government is in debt. They need to pay their bills. So they issue these bills and they pay interest on them, right? So you can buy these bills and the government will pay you interest. And then the good thing about treasury bills is that they're for short timelines. So they're 4 week, 8 week, 13, all the way to 52 weeks. And I like them because they have a competitive yield. They're short, right? They're backed by the U.S. government, so you're going to get your money, right? Default did never not paid them. They've always paid them, and they often have state tax advantages. Depending on your state, you may get some advantages there. Now you can compare between the different options, but this is another good one. Now, if you don't need the money in 3 to 6 months, these are worth looking at, and you can also ladder them. So maybe you have one for 4 weeks, you have another one for 8, and then every month they can kind of be paying you interest, which is pretty cool. That gives you that flexibility there. Another option is money market funds. And this is one of my favorite ones because these have really good yields. These are held with brokerages. The high yield savings accounts are with banks typically, and credit unions, banks. The money market funds are with brokerages. Some banks have a brokerage arm. So think of Merrill Lynch. They're owned by Bank of America, or JP Morgan Chase has a wealth management division. Vanguard is also a brokerage. And you can buy a money market fund in the brokerage, and it has a yield that it pays you based on your funds that you have available there. It's a strong place to put, a part capital. And really, I actually recommend, I love Vanguard for this because they really have low fees. So they're charging you very low fees for that investment. That's the only thing with when you have a fund, the fund has a fee inside it. So now my favorite concept out of all this is having optionality, right? So thinking about this and having access to the capital. Another thing I didn't mention is, and that really takes away optionality because it's locked in and then it has a fee if you decide to take it out. It's a certificate of deposit. A certificate of deposit is held by a bank or a credit union, and they also have a good yield. And it depends. Sometimes they're higher than the high yield savings account. They could be higher than the money market. So you really have to compare different options. But these accounts are basically locked in for 6, 9, 12 months or longer. And you would get a return by leaving the money in. Now, that if you can take it out earlier, but you'll have penalties if you need to take it out earlier. So, not my favorite thing, honestly, but it depends on the yield, right? If you don't need the money now and it has a great yield, something to consider, something to consider. But I like having the optionality because it's cash is not just return, it's optionality. It's having the flexibility where there's not that many great deals out there, but when they pop up, you have your cash ready to go. You can move quick. If there's a panic, you can buy stocks or real estate. When life happens, you're calm, right? Because you have your reserves and you have choices when things happen. So that flexibility has a lot of value. Sometimes earning 1% less, but keeping that flexibility may be a winning move. You evaluate your situation. So where would I avoid, right? So those are the places that I would invest, but what would I not invest? Where would I not invest? And one of those is stocks or related ETFs that invest in stocks. I would also talk about bonds as well, because typically bonds are over a year. And then bond funds as well, because they can fluctuate with the stock market, right? So I wouldn't invest any of those stocks. Some people would say, oh, no, but I can invest there and I can sell it within 6 months, or some people even day trade. The market can go down 20% in a day, right? So it has that risk. And if it goes down 20% a day, it could take 2 to 3 years for it to recover that. So for stocks, really the timeline that's recommended is 3 to 5 year minimum and to invest in stocks. So if not, it's not a good tool to invest your money. Even great companies, great industries, the whole market is down. Those great companies are down. That's a time to invest if you're willing to hold it for that time. But if you're holding it already, you can't sell it or you shouldn't. So you're going to take a loss. Another one is crypto. If you need that money within a year, it's too volatile for money if you need soon. And it's very speculative, right? So the parking capital. So, if you're willing to risk it and lose it, maybe it's an option for you. But it's a very speculative asset. We really don't know because it's not being held by anything. It's really held by, it's becoming more institutionalized now, but you don't own a company that earns revenue. The usage of the coin, which is the Bitcoin and the Ethereum, are the most popular ones, but it doesn't have any company behind it where you own the stock and the shares and that's selling products. Like a stock, you actually own a certificate and that's they're selling products and they have revenue. And like example, Netflix, right? So they have subscribers, right? So Bitcoin is more of, it's like a, people are using it to exchange and to pay things, but there's not anybody that's out there. Bitcoin is not selling products. So we'll leave it there, but be careful with that one. All right, real estate. I love real estate. Real estate is a great wealth building tool. However, it may not be the best tool for 1 year money, especially if you're doing rental properties. Rental properties, they take a while. You have to buy it, you have to rent it out, you have to make probably a 1 year lease typically. Then when the person moves, you need to get it ready again to sell it, and then you need to sell it, which takes some time. So that could take a year and a half, right? There's closing delays, there's repairs, there's leasing, there's vacancy, there's maintenance, tons of stuff. I wouldn't do rental property. I would consider becoming a flipper, or it's like a hybrid approach, or even being a private lender. But this is something that you need to build some skills to make sure that you're doing it right. You need to evaluate borrowers, you need to evaluate properties for collateral if you're going to be a private lender, or if you're doing a flipper, you need to make sure you know how to manage contractors, and then you need to make sure that you know how to run numbers on the property so you can sell it. So that's something to consider, but make sure you do the other side of the educational component to make sure you're doing it right. 1 year goes fast. So, you know, be aware of that with those products, real estate. Private businesses, whether it's a startup or an existing, I would say it's much longer term than a year. If it's a startup, it has a high likelihood of failure. So, you know, think of that. I put it on the speculative side like crypto. You may not, it may or may not work. So you need to know that. And then if you're investing in an existing business, it's probably going to be longer than a year. Wrong place for your money with a near term deadline. So what would I do at the end of the day if I had $100,000 and I needed it in about a year? Would I spread it around different things? I would look at what has the highest yield, and I would lean on a high yield savings or a money market because I would have access to it right away. I would want to have access to my money if I needed it. And those things are safe, they have a good yield, they're flexible, and I would be ready for any opportunity. If something pops up, I can jump on it, right? So it's also a good place, not even if you're going to need it in a year, if you're going to need it sooner, you just want to keep the money there earning something while you're waiting for an opportunity. And sometimes you wait for opportunities, right? You don't know exactly what's going to pop up yet. Now, so wealth is not just making money, it's matching decisions to reality. A lot of people lose because they mismatch those things, their short term goals with long term assets. So don't do that. 1 year money should behave like 1 year money. Protect your principal, number one. Earn something, but stay ready. If this helped, subscribe to Prosper Without Permission. We talk investing, business freedom, and building wealth intelligently. Drop a comment. Where would you park $100,000 for 1 year? See you in the next one. Take care.